Hello there, I'm Ameera David. This is Boom Bust, and these are the stories we are tracking for you today. Well, the Indian cash crisis continues as 20 billion plus banknotes get purged from the system. But now critics are speaking out, and I've got the details on that coming right up. Then the UK gets new surveillance powers. How will it change internet privacy for millions of Britons? That story straight ahead. Plus, the European Central Bank seeks to lend out more of its massive bond portfolio, all in the hopes of easing stress on the financial markets. But will it work? That's the big question that Ed Harrison will answer in The Big Deal. All that and more lined up for you on today's show. Don't go anywhere. It all starts right now. Billions of banknotes destroyed. That's the new reality facing India, the country that must now expunge more than 23 billion worthless currency notes. All of it, of course, the result of a bold decision made by Prime Minister Narendra Modi to invalidate the two largest banknotes in a bid to undermine pervasive corruption. Those two banknotes, however, are the most widely used forms of currency in India. So the decision effectively has rendered 86% of the entire cash money supply in the country useless. And it's for that reason that this move is being called the world's most sweeping currency policy change in decades. But the policy has left millions of Indians waiting in lines at banks and ATMs as they rush to change out their old currency by an end-of-the-year deadline. It's also left people questioning whether the end will justify the means. Some Indians are now starting to lose their patience with the Prime Minister's move, arguing that the new policy is hurting the poor more than it is the rich. Here's a look at what one New Delhi resident had to say.
So hopefully with this decision, the fake notes will be taken out from the system. But at the same time, it is causing a lot of hardship to the poor people because they have very limited currency. The banks are closed and they cannot change their old notes into new notes, and they cannot do small shopping or small things like hiring a taxi or an auto or buying milk. For this, they are having a lot of hardship.
Hardship, he says. As for economists, they're still divided on whether the policy will do more harm than good. While some say the banks can use the deposits to lower interest rates and lend more to new businesses, others have argued against the premise that the strategy will remove quote-unquote black money from the currency circulation. But one thing is for sure, if successful, this will stand as the most impactful reform India has ever seen. In our post-Snowden world, the right to privacy has become more valued than ever. And that's why some in the UK are now up in arms over a new bill that now gives the government sweeping powers over user data. Boom Bust, Bianca Facchinei has the details.
Privacy activists in the UK aren't too happy right now. Last week, Parliament passed a bill that will essentially legalize the spying programs that were exposed in the Snowden leaks. The legislation is called the Investigatory Powers Bill and is expected to be implemented by the end of 2016. One of the biggest points of contention in the bill is the data retention notice that the government can issue to internet providers. Officials will be able to force the providers to record and store up to 12 months worth of logs showing the websites visited by users, and they won't need a court order or warrant to do so. The bill will also hand new powers to police and tax investigators, which will both be able to hack into phones and computers with the government's approval. Similar abilities will be given to intelligence agencies as well. The passing of the bill has left a lot of people upset, like privacy expert Eric King, who said, "There is no other democracy in the world, possibly no other country in the world, doing this." He added that it will scare and inevitably change the way people communicate with each other over fear of mass surveillance. Other activists emphasized their concerns over what this could mean for privacy in the rest of the world, in both democracies and authoritarian regimes. To ease some of the worries, the government created a judicial commissioner position, likely to be filled by a former judge. and authorities will have to get permission from the commissioner before spying on journalists to reveal their confidential sources. So the new position, which was not in the bill's original proposal, really doesn't address all the biggest concerns people have, and it has so far failed to relieve journalists of perceived threats to press freedom.
I think the question here, Bianca, is how this law is going to be misused. I think that's the real concern here. And tell me, I mean, have internet service providers, have they said anything about this?
Yeah, so earlier this year when the bill was first being debated, a lot of companies came out against it. Facebook said that, Google, Vodafone, they all said they do not support it. One, because this is going to be an added cost for them. They're going to have to store all this information. And two, it would really cut into their overall business model. Like we said, privacy is very valuable these days, so this could, upend their business in the UK in some aspects.
Yeah.
So far, since the bill has passed, these companies haven't spoken out against it yet, but I'm assuming, they eventually will address
they absolutely will. This is not the end of it. And as you said, I mean, it goes back to their bottom line. Consumer trust really feeds into that. That's very important to these companies. All right, we will stay on top of it. Bianca Facchinei, thank you so much for that. Recently, gold prices have come off the boil, with a troy ounce even trading below $1,200 today. But we've had guests like Jim Rickards who tell us central banks in Russia and China are buying up physical gold and making it unavailable for paper gold collateral. That's a problem. So we asked our next guest, Sprott U.S. Holdings CEO Rick Rule, how he saw overall global demand trends supporting gold in countries like China and India. Take a look at what he had to say.
We're seeing strong investment demand in China and India and weak jewelry demand. Jewelry demand is often very price sensitive, and it's important to note that it's price sensitive in currencies like the rupiah, which have been doing poorly against the dollar. So the gold price is up fairly strongly in those currencies, which reduces consumer demand or jewelry demand. Gold investment demand is still strong in most markets, including, of course, North American markets.
Well, some critics are quick to point out that despite central banks adding, I think it was 13 tons of gold to their stockpiles in September globally, that we still did get that correction in October. So to their point, I mean, what's the rationale for why the renewed demand wasn't quite enough to push gold prices up?
I think you had some disintermediation from the large ETF. That is, some U.S. retail holders expressed through GLD sold some gold. I also think that there was reasonably soft jewelry demand, softer than expected jewelry demand in South Asia and the Middle East.
Why do you think that is? I mean, the soft jewelry demand, because I've been reading reports that say, given what's going on with the festivals in India and their culture and the demand for jewelry around this time of year, that was going to be really bullish going forward.
We had thought the jewelry numbers from Southeast Asia would be stronger than they were. But you have to think about the price rise that has happened in gold in terms of the Pakistani, Indian, Bengali, and Sri Lankan currency. The truth is that the sticker shock year on year, last year to this year, in gold prices in those currencies has been very high. So there might be an affordability issue. We're seeing very strong silver physical demand, jewelry demand in those markets. And it could be that there's a trading down from gold to silver simply as a function of affordability in those currencies.
Yeah, I want to ask you about silver in just a second, but it does seem to me that whenever gold corrects, we do inevitably get a lot of criticism from people who get bearish, frankly, on the commodity, who immediately reduce their price forecasts. And I'm assuming you'd say that's a rush to judgment, but what would you say to investors out there who are constantly sorting through all this noise? What should they be looking at that can best signal to them or ensure them that we are, in fact, witnessing a bull market run?
I think those investors, particularly American investors, need to understand that gold really for 40 years has traded inversely with the U.S. 10-year Treasury. 2 points to that. The U.S. 10-year Treasury has been in a 35-year bull market. I suspect with the interest rates where they are, that market is closer to the end than to the beginning. And if you believe that the instruments trade conversely to each other, that would mean that gold is closer to the beginning than the end of its market. Secondly, I think investors need to ask themselves whether the U.S. 10-year Treasury at this interest rate is in fact a good investment, or whether you look to what Jim Grant has said and characterize it as return-free risk. If you decide that the U.S. 10-year Treasury at this point in time represents return-free risk, then gold is attractive indeed, not merely as insurance, but also as an instrument that's a store of wealth.
Yeah. Well, let me just get your thoughts lastly on silver. It does always seem as though silver is the less preferred investment to gold. But given the metal is heavily used in industrial activities and given the uptick we have seen in manufacturing activity in key economies, could silver actually be poised to lead gold in 2017?
I think that's an excellent observation, Ameera, for a couple of reasons. One, it is the poor man's gold. Two, in prior gold bull markets, gold has led, but then silver has gone further faster. That's exacerbated now because most silver is produced as a byproduct of other metals. And with copper prices, lead prices, and zinc prices very weak, it is likely that silver supply, primary silver supply, will fall over the next 2 years at the same time that industrial demand, particularly demand in the solar industry, solar cell applications, is beginning to increase. So I think that silver can go higher, both as a consequence of its relationship to gold, but also in terms of primary supply and demand, reduced byproduct supply, and skyrocketing fabrication demand.
Yeah, and are there any other precious metals you're keeping your eye on right now?
Well, I like the platinum and palladium business, although so far that's been a very harsh call for me. We see difficulties in production in Russia and South Africa at the same time that we see wonderful utility in the platinum business in catalytic converters for automobiles. You know, Ameera, it only takes $125 worth of platinum to sell a new car and enjoy the high quality of air that we breathe in the West. The truth is, if the platinum price were to double, I don't think it would change demand for platinum a little bit. If the price has to go up, and the price can go up, eventually the price will go up.
All right, there you have it. Still ahead here on Boom Bust, we are talking about Atlantic City. It's the U.S. gambling municipality now under control of the state. And our next guest says it's better off that way. That's coming up. Plus, the ECB considers lending out more of its massive bond portfolio in the hopes of easing stress on the financial markets. But will it work? Ed Harrison weighs in on the other side. Stay with us.
As president, one of Donald Trump's most important challenges will be to improve relations with Russia. He faces enormous resistance from the media, the foreign policy establishment, and even his own party. What are the chances Trump will succeed?
The election of Donald Trump may have defied much conventional wisdom, and yet a significant margin in electoral college votes suggests it didn't come completely out of the blue. Why did so many experts fail to see him coming?
Responsible employers, Social Security, proper working hours, full salary. In European companies, this is not as typical as you might think.
Fazíamos horas. E por semana, 50, cheguei a fazer 80 horas.
80 horas. Mensen zijn bang om met ons te praten, mensen zijn bang om hun gegevens, mensen zijn gewoon bang voor hun baan. En ook terecht, want mensen die met ons praten, die verdwijnen.
Verdwijnen?
Ja, die hebben geen baan meer.
What will be the answer of the authorities?
Ik vind dat een eigen verantwoordelijkheid. Maar het gaat om publiek geld. Ik vind dat een eigen verantwoordelijkheid.
Het bedrijf waar ze bij in dienst waren. En toen kwam ik terecht bij inderdaad sites in Zweden, Frankrijk, problemen in Denemarken, in Duitsland. Toen bleek inderdaad dat dat bedrijf in heel Europa in op.
The truth about just one of the construction projects in a prosperous state. Investigative documentary, Down the Drain.
re-election of Donald Trump now dominating the news in the U.S., municipal and state issues are not quite getting the play they deserve. But when it comes to infrastructure, Trump and issues in municipal finance really come together quite nicely. So we invited Cate Long on the show to give us an update. Cate is a partner at Puerto Rico Clearinghouse and also an expert on municipal finance. I first asked her if, given the structure of Trump's infrastructure plan, whether critics were right that it will be difficult to get a project at the magnitude of what Trump is pitching done effectively. Take a look at what she had to say.
No, I don't think so. I mean, I think, is there $1 trillion worth of infrastructure that needs to be built in the United States? Absolutely. I think, the engineering, the engineers, the National Group of Engineers says there's almost $4 trillion worth of infrastructure that needs to be built. I think, bear in mind, though, with the proposal the kind of murky proposal that's on the table from Trump right now, the projects that are built have to have revenues that repay either the equity investors or the bondholders or the debt holders. So those are projects that are things like bridges, tolled bridges and tolled roads, things that are already happening, like college dorms, where the fees that students pay to live in the dorm pays back the bondholder. So you need projects that are cash flowing to do the kind of structure that's being discussed by President-elect Trump right now.
Yeah, that's a very good point. Let me ask you about Atlantic City, where, interestingly, speaking of Trump, the Trump Taj Mahal just caved not that long ago. It's the 5th casino to go down in 3 years. But amidst that, we have the state of New Jersey, of course, taking over the city's finances after rejecting the city's proposed 5-year plan. What do you think really drove that rejection?
Yeah, I think that at the heart of it was this proposal to sell this old airport, essentially, they have to the water system and raise cash that way. And that's just kind of a little bit of a Ponzi kind of effort. It doesn't really address the deeper fundamental structural issues that Atlantic City needs to get to. And from what I understand from the oversight that's being appointed by the state, this is someone very close to the governor, Chris Christie, is that he has ability now in the law to hire and fire people, to sell assets, to talk to bondholders in terms of starting restructuring talks. He has a lot more authority than the mayor has under current law. So it's just putting like almost the parent coming in with the authority a parent has to tell the kid to clean up their room, and we're gonna get rid of some of this stuff and we're gonna downsize. It's just, there's a lot more power inherent in what the state has when they come into Atlantic City.
Yeah, as you said, I mean, they can now break union contracts, hire and fire workers, sell city assets, enter into shared servicing agreements, restructure debt. What do you think, out of everything that they now have the ability to do, what do you think is priority?
So the other thing is, in Atlantic City, is very odd, but they had overcharged a lot of these casinos for real estate taxes. And it was litigated in state court, and then essentially the court told Atlantic City they had overcharged these casinos and they have to pay back. And the big one now is Borgata is owed around $150 million. So this is just an enormous burden on the city that, again, this state oversight coming in can begin to address that in terms of either cutting deals or creating some kind of structure that can be done, where they maybe forego real estate taxes over a period of years to repay that or something. There's just some really big issues like that I think the state oversight will help with.
And just to be clear, I mean, you're saying you believe more or less that Atlantic City is better off under the state.
Oh, absolutely. The same for Puerto Rico. When a smaller municipal entity gets in really big trouble, generally the bigger one comes in and takes over and uses either broader authority or the larger financial resources that they have to help out. And that's just really what you're seeing in Atlantic City and what you saw in Puerto Rico.
And let's be clear that this is not the first state takeover of a New Jersey municipality. I mean, the most recent example was Camden back in 2002. How do you compare the takeovers, the level of intervention, et cetera?
Right. So, you know, Atlantic City, although it's much smaller than it had been when, you know, in its sort of boom time, it's still a functioning city. It still has, you know, revenues. People still come there to do. Camden, on the other hand, has, you know, is an old industrial city, old manufacturing city that basically just collapsed. The state, I think, in the case of Camden, tried to, or funded a lot of development there that didn't necessarily create a lot of jobs and really didn't generate a lot of property taxes for the community. And because they built things like colleges and hospitals, which typically don't pay property tax. So I think that the model that state of New Jersey used in Camden is not one they should try to replicate for Atlantic City. You know, I don't think it was well thought out at the time. I think there was a lot of politics involved. And as I understand, Camden has a higher poverty rate now than when the state took over, you know, in 2002. So that's obviously a very bad indicator.
Yeah, that's unfortunate. Well, let me ask you lastly about Christie, because as the governor of the state, he's been managing the city's fiscal crisis for quite a while now. What happens if and when he gets appointed to a position within Trump's administration? Does anything change?
Well, one, I don't think he's going to be appointed. I mean, that's my own view. And I think that, yes, I think the people that are, you know, not the lieutenant governor that would step in immediately, but longer term, I think that there's different points of view of people that will be running for governor in a year and a half. But you know, Atlantic City's problems are going to take 10, 15 years to work out. So we'll probably see a succession of governors rotate in and out of that, you know, position before Atlantic City is fixed.
And out of curiosity, why don't you think he'll be appointed?
You know, I think that generally he's done a very bad job on the transition, what he did do. You know, and just the read that I'm getting, Bridgegate was very damaging to him. You know, personally, for 4, 5, 6 years, I have not thought he was a good administrator. The state of New Jersey's had 10 credit rating downgrades in the time that he's been governor, which far eclipses any other state in the country. He made these promises about the pension system and then didn't follow through. I just think he's run the state in a very poor way, and I don't see, other than, you know, some personal connection he has to the president-elect, I don't see on an administrative basis why he should go to the federal government.
It's big deal time. I'm back in D.C. with my friend Ed Harrison. Now, we are talking about the ECB. The ECB is reportedly looking for a way to lend out the massive quantity of government debt it has been hovering up via its quantitative easing program. Why? Well, they're worried about a freeze in the 5.5 trillion euro short-term funding market that underpins the European financial system called the repo market. Put bluntly, if the repo market freezes up, it could cause a liquidity shortage and thereby another financial crisis. And Ed, nobody wants that, of course. But, you know, this big QE program has been underway in Europe for quite a while. We've all been led to believe that it's working, that it's going to boost the economy. What is this move, you know, that they're considering? Of course, you know, more sale here. What does this really say?
I think it says that we're in uncharted waters, that this is untested, and these are extreme policies that they're taking on. That is negative interest rates and quantitative easing. You know, they're still at a very extreme policy. Look at the German 2-year as an example. German 2-year reached today a record low level of something like 74 basis points, below zero, I might add. And so, you know, there are a lot of unintended negative consequences from their policy. One negative consequence that we actually haven't talked about a lot on this show is the shortage of safe assets. I mean, with quantitative easing in particular, they're sucking assets, that safe assets, out of the economy and hoarding them on their balance sheet, not making them available for people to use as collateral in things like the repo market.
And as I understand, repo is regarded by the ECB as the key avenue to really transmit stimulus to the economy. Talk a little bit more about how that works. Yeah, so I'm looking at some of my notes. A good way to think about a repurchase agreement is it's a form of short-term borrowing between these dealers and government securities.
where the government, the guy says, you know, we're going to give you on an overnight basis this particular bond, and you agree to repurchase it, to let us repurchase it from you. And so that's basically a loan for a very short-term period, and that's sort of the underpinning of the market. Now, the reason the repo market is important is because everyone's involved in it. A perfect example is in 2008 when Lehman Brothers went under and then AIG was rescued. Literally the next day, Morgan Stanley said, by Monday, we won't be open for business. They told Tim Geithner this. If you don't give us liquidity, because basically the repo market's been, you know, it's been screwed up. And if Morgan Stanley went under, then we know that Goldman Sachs would have gone under, and we would have had JP Morgan, despite their so-called fortress balance sheet, they would have gone under. So the whole economy in the U.S. depended on the repo market. The same is true in Europe.
Yeah, it's very scary, the parallel, really. And talk about the shortage of safe assets some more, because I know, I mean, David Beckworth is a guest that we've had on our show, Boom Bust, many times in the past, and he's spoken about this. What are the big takeaways from his research?
Yeah, I think the big takeaway was that when you look at it from the U.S. perspective, because we haven't gone to negative interest rates, that there was the zero lower bound. We weren't going to go against it, and basically because there weren't a whole lot of safe assets out there for people to use for this collateral, it was almost like the market clearing rate was below zero, meaning that people were willing to pay more for the asset than it was worth in order to get it just for its security purposes, and we weren't able to be able to do that. The Europeans have done that, obviously, by going below zero, but as I've said, they've created other problems with what they're doing, including taxing banks for holding excess reserves. But I think that, you know, Beckworth was saying there are two potential problems, or two potential solutions to that. One solution is that you get the market to believe that you're going to do some serious stimulus and the economy is going to get better. So they don't want to hold safe assets. That's what I would call the Trump solution. That's what he's done, and that's why interest rates have gone up. The other one is that you deficit spend. I mean, to a certain degree, this is what what people think Trump's going to do, is he's going to deficit spend. So one is it could be implemented by the central bank. The other could be implemented by the government.
Okay. And we know that the Germans, they want to keep their fiscal restraint in place. So does that mean that the ECB is really the only game in town?
It definitely does. I mean, like the Germans right now are talking about their budget for 2017. They have this thing called the Schwarze Null, which means that no way, it's a black zero. It means that we're not going to have new debt. So they're saying we want no new debt, and we want to make sure that everyone else has no new debt as a result. So what they're basically doing is they're decreasing the amount of safe assets that are out there. And that leaves, as you were intimating, the central bank is the only game in town. So the central bank has to come up with a way not only to deal with inflation and make sure that the market's clearing and so forth, but also deal with this whole concept of the shortage of safe assets.
We're done, but really quickly, are we immune in the U.S. from this kind of activity?
We're not. You know, this is exactly what I was talking about with Morgan Stanley and Goldman Sachs. But we've been there, done it, and so I think we're a little bit more ready for action.
So hopefully we've learned a lesson too. Ed Harrison, thank you for that. That's all from us. We love hearing from you guys. Tweet at us, Edward NH, Bianca Facchinei, Ameera David. Remember, check us out on YouTube, youtube.com/BoomBustRT. From all of us here at Boom Bust, thanks for watching, guys. We will see you next time.